we're just going to kind of check out bonds. Again, we don't really own bonds. I don't think anyone thinks bonds are going to make money over the next 2 or 3 years, right? As interest rates come up, the bond prices go down, right? Interest rates are on an upswing for sure. So I don't think anyone here owns bonds to make any money, but we own a lot of them as a firm. The reason is for safety in your portfolio, right? It's a rock in your portfolio. So let's kind of talk about how some of this works. This, again, I talked about interest rates, kind of concerns me. I'll go through it fast. The 10-year Treasury, this is the average yield or interest rate, and the gold to copper ratio, to kind of divide the price of gold and copper. It usually tracks pretty close, right? Usually tracks interest rates. You could see for a while here, the gold copper ratio was lower than interest rates. Interest rates are probably artificially high then, right? Because people were worried, actually the market was overheating. So then, boom, interest rates came down and they came back into line. Well, now the gold to copper ratio is going up a little bit, and what's happening to interest rates? They're not keeping up. So if interest rates kind of come back up, I'm hoping the light blue line comes down a little bit, and then the dark blue line comes up a little bit, and it meets at like a nice equilibrium. That is manageable, right? We can digest that as an economy and as a stock market without having a huge crash. But if those interest rates catch right up to it quickly, especially in the next month or so, as Powell starts to shrink that quantitative easing, that's something to watch for. That's very, very, very important. And we will be watching that very closely. With this, again, I think bonds, most people don't really even understand them in the first place. So I tend not to spend too much time on them, other than basically, this chart shows, will bonds make any money in the next 2 years? And the answer is probably no. Right? Interest rates are going to come up, bonds are going to lose a little bit of value, and they're not going to make much, but they're not going to lose much. How we're using them as a firm is as a conservative portion of the portfolio, in addition to maybe a few other things depending on the client, as well as a holding tank for rebalancing. So we rebalance every 3 months. In 2019, as the stock market was booming because of the Trump corporate tax cuts, we were selling stock every 3 months and buying bonds. Then when COVID happened, the market came down 40% in 40 days. We had bought all those bonds the year before. Those bonds didn't lose really any value. So we sold a bunch of them and bought within 5 business days of the exact bottom of the market, right? Not because we're geniuses, but because it was time, right? It was that quarter. It was time to rebalance. We sell when things are high and we buy when they're low. So we took a bunch of the bonds out that lost no money, bought the stock market while it was down 40%, and it's up like 70% since then. So now for the last year and a half, what we've been doing is the opposite. Stock market goes up, we've been selling and putting them in bonds. And now if the market comes down over the next several months, we will have bought a bunch more bonds and we'll buy the stock market while it's really low and we'll ride it back up and then we'll start selling some of those gains out. So we use them as a rebalancing tool more than we want to make money on the investment, and as a cornerstone of your portfolio that's not going to drop. And this next slide kind of shows that. So here is when the Treasury securities have done positive when equities were down. So here's the stock market losses. And again, these are just in 1 month. So you can see there's almost 20% in 1 month that was lost at one point. And so when the stock market goes way down, this blue color, this light blue is what bonds do. So as you can see, almost all of the time, they do fine, right? So while the stock market's down, you can see in any given month, you can see they're down 5 or 10%. Almost every single time, the bonds are doing fine. This is the exception, and this was in 2008 because it was a banking crisis. When there's a banking crisis, interest rates don't work how they usually do, and bonds do lose a little bit of their value as well. But in any other sort of crisis other than banking, as you can see, I mean, even out here, what does that look like? Maybe a 0.5% loss. So that's why we do own some bonds still in our portfolios. So again, we don't expect them to go to be like this amazing, income driver. But we do expect them to hold up if the market does drop and if we're wrong. And if one of these things, whether it's inflation slams us or interest rates, which I think is the most likely one, slams us, or Biden's tax increases, hurt the economy more than everyone is going to think, and corporations basically just get scared of it and stop spending. That's a problem. So, I mean, there are things that can happen, and that just in case we want to still own some bonds, and we're going to rebalance in and out of them. So we don't own just the same ones forever. So kind of in summary, what I would say is, if we can kind of get through the bond ones here, that of all of the things that are out there, Fed stimulus kind of going away, right? The Fed's shrinking their balance sheet. If that gets bungled, that could kill the market. They hadn't bungled it last time. And I think that they're trying to communicate very efficiently. They've been telling us for 6 months that quantitative easing is probably going to happen in the fourth quarter, which is like tomorrow. So we would expect that to happen soon. And it's not a surprise. They've been telegraphing that and telling us. As long as they do it slowly, which it looks like they're going to, I don't expect that to kill the market. Inflation is something that I think is a problem, like just supply chain problems and inflation. The Federal Reserve Chairman Powell thinks that that is not that big of a deal. And because he is a little bit more powerful than I am, we should listen to him. So he believes that inflation is going to go away effectively over the next 6 to 8 months, because supply chains will kind of get figured out. And, you know, we're going to be able to get like the billion things from China over to here and start like a more typical system. Plus, it takes a year or two to build plants. So people that want to insource, you know, or onshore some of their supply chain, you know, those plants will be coming online. So Powell doesn't really worry about inflation. If inflation is big in 6 months, that's going to be a problem, and that could tank the economy. Because once inflation is high, what has to go up? My number one concern, interest rates, right? And interest rates go up, and there's 5 or 6 other things then that hurts. So inflation in and of itself is not bad. Do you guys remember? I mean, I feel like I talked for 10 years about, oh my gosh, there's going to be deflation, and we're going to be Japan. Like, we need to figure out how to make inflation. Now there's some inflation, and everyone says, oh my gosh, you know, we've got too much inflation. So I personally just feel like a year or two of 4% inflation is not going to kill anyone. Now, 3 years of 10% inflation, right? Now you're Argentina. So you do have to absolutely watch it, but I think we're like nowhere. I mean, if we're in like a spectrum of 1 to 10 of inflation, 10 being like a huge problem, it's like a 3 right now, maybe. It's probably a bigger deal to people's pocketbooks, you know, and their wallets and their purses than it is the actual stock market. Because, you know, even my wife has mentioned, she's like, man, my grocery bill's going up. The only plug-in hybrid SUV I could find that was a couple years old takes premium gas. I paid like $3.80 for premium gas today. So I noticed that is going up as well. So I think that inflation is going to maybe like hurt people's spending a little bit. But again, I don't even think that's that much. And I don't think it's enough to really hurt the stock market. And if it is, that's going to be a problem because more of interest rates. So I don't think taxes are going to be the thing that's going to knock it down. It's just not going to be enough. Now, does that mean I expect the market to be up 20% a year? No, because I expect all of these things to impact it a little bit. So my hope is that earnings can go up by 10 to 12, 13% a year, which would then cause the market to go up by an equal amount. But then you start to see a shrinking of that price to earnings ratio. So yeah, earnings might be up 10%. So you'd think the market's up 10, but instead it only goes up 5 because price to earnings ratio contracted a little bit. So where you would suspect an 11 to 13% increase in profit should lead to an 11 to 13% increase in the stock market, it won't. It might be like 6, you know, because there'll be, you know, another 5 to 7% in, you know, in price to earnings contraction, getting us back to normal, which would be great if that happened if over the next 2 years, profits are up 10 to 12, 11 to 13%, but the market was only up 5 or 6, and interest rates slowly came up and got back to a typical like 2.5 to 3% on the 10-year Treasury over the next 3 years. And our price to earnings was back to 17 or 18. Interest rates were back to normal. The government had stopped quantitative easing and inflation had leveled out at 2.5%. We'd be in a Goldilocks economy, right? That could now sustain for another 6 or 7 years, and we could get close to the 10 years that we were at before. So as long as everything gets back to normal over the next, I think, like, let's say 3 years, even 2 to 4, I think we're going to be okay. Anything that kind of slams into us, though, because these valuations are so high, they're teetery, and they could come down fast. So I think from our perspective, that's like what we're really looking for is anything slamming into us instead of going up gradually. And if it goes up gradually and we could expect single digits, you know, mid single digits in the stock market for the next 3 years, I'd be ecstatic. Because then after that, I know the next 5 to 7 years could look awesome because we'd be like kind of right back to where we were a couple of years ago, like right in this Goldilocks economy. And anyone you know who's not working, tell them to go to work because that worries me a little bit too, that we don't really have enough workers. But again, I don't know if that's going to necessarily kill the economy. I think it'll kill certain sectors of the economy. Like the other day, I had to drop my son off at his tutor, and we went to look for food. And we tried like 4 fast food places. They were all closed because they don't have any workers. So I don't know how important fast food is to the economy. I would guess probably not that important. And who knows, maybe we'll all be healthier and use less healthcare as a result of not being able to go to fast food. So with that, that's about it. So in summary, if it's steady, we should be good. If anything slams into us, we'll have to watch it super close. And even that might not derail us.